Good morning, everybody. Today, I want to talk about something that is very, very important when it comes down to a business. A lot of people are struggling with this because what they don't realize is that there are certain things that the bank does care about, and there are certain things that the bank does not care about. Now, the reason why this is even a topic is because when it comes to running a business, what you will realize is that at some point, there may be a need or there may be a requirement or there may be some involvement where you do need to take out a loan or you want to use other people's money to grow your business. I mean, it's called leverage in business. And I know different people have different feelings about it. Like, we're doing everything with no debt at all. And I will say, business debt is completely different from personal debt. So you have to learn how to think about business debt in terms of like, hey, how can it be productive if you choose to go that route? Now, there are some people who choose to build their business with no debt at all. And there's I guess there's nothing to say that that is wrong. It just means that, hey, if you're going to build your business purely on self-funding it, it's going to take you a little longer to actually build it out in most cases. But if you're really trying to scale your business, or let's say you're trying to really build something, a little bit faster, using other people's money becomes a very a lot of our clients, we've gone through different stages where they've been expanding, they've been adjusting. And in the past year, we've helped our clients raise over $2 million when it comes down to funding. And in that process, we've learned a lot from, going to the process of getting loans and helping them figure and navigate that out. Like, we've learned a lot. And so what I wanted to do is pretty much create a course that puts all that in there. Now, what I'm doing here is right now, I've just suspended the courses. And what I've decided to do is just to do this, take the main points in those courses and just put them in live videos like this. So you're about to see the main points that I took out of that course that I'm just going to give you for free. But before I do that, for those of you that aren't familiar with who I am, my background is accounting and finance. I am the managing partner of the TL Turner Group. We work with small to medium-sized businesses that are trying to grow, helping them really get a good handle on their bookkeeping, as well as start to navigate that strategy looking forward from the CFO side of really helping them understand where do they need to spend their time, what areas are very profitable, what are some great opportunities. And then we create a lot of free stuff like this. I mean, on the Business Talk Library, we have over 470 interviews that we filmed and different videos that we've created to really deal with different topics like this. Now, today, how to have a bankable business. Now, this becomes important because, like I said, if you want to grow and you're trying to really take your business to the next level, being able to get access to funding is very, very important. Now, to be able to do that, you need to understand there are some things that a bank does care about, and there are some things that a bank does not care about. So first, I want to start off with, what does the bank not care about? I mean, what the bank doesn't care about is very important, is very big to know. And I will be honest with you. Before I show you this list, I'm just going to give you a warning. Some of it does tend to shock some people when they find out, oh, the bank doesn't care about this, because they spend a lot of time investing energy into this. And I'll say in the past year, in dealing with banks, as well as, whether it's the SBA, whether it's commercial banks, whether it are, credit unions, or whether they are third-party private lenders, we've been dealing with a lot to help our clients really get the funding and access to the funding that they need. And we've learned a lot. And in that process, we've also interviewed loan officers and banking professionals at different institutions. And we've gathered a lot of interesting insights. So here's the list of what the bank doesn't care about. This is what we saw to be very common. First is, the bank doesn't really care as much about your company mission, in which a lot of people put a lot of energy and a lot of time into it. Now, I'm not saying that you shouldn't have a company mission, and I'm not saying that you shouldn't invest energy into it. That is great for you to have clarity about where your organization is going and for the people internally. But when it comes to the bank, they just don't care about that as much. I mean, of course, they do want to know that, hey, you're not doing something malicious or something that really undermines their value. But for the most part, that's not a top priority for the bank. The other thing, which this one ends up being this one surprises a lot of people is your business plan. The bank doesn't care as much about your business plan. I mean, which it sounds a little interesting where people are like, well, I have this amazing business plan, because there are some amazing business plans that I've seen different businesses take to the bank, and the bank spent zero time really looking at the business plan. Well, let me not say zero time. They wanted to understand what's the concept of your business, what's the nature of it. And once they understood it enough to be able to say, okay, all right, that's like XYZ, cool. They didn't look at the business plan much more after that. The other thing are your awards. Now, I know a lot of people, you're very proud of the awards that you have, and you're very proud of the recognition that you have, but the bank just doesn't care as much about it. One of the things that I've realized in this past year is that, awards don't always directly mean that your business is growing. It doesn't directly mean that your business is successful. What it just tells me is somebody's recognizing what you have done. I mean, and that doesn't necessarily mean a whole lot when it comes down to, like I said, when it comes down to whether your business is a good banking decision. The other thing is the bank really doesn't want to own your collateral. Now, a lot of people tend to think like, oh, the bank is taking advantage of me because they want to take my collateral. Like, the bank really is not in the market of owning your collateral. Because if the bank were to take your collateral, if they did that for too many people, it would completely change their business model. And they don't want to do that. The bank is not as interested in those things. So when it comes down to, if you're trying to figure out, how do I make my business more attractive so that I can get loans, I can, be able to access funding. Remember, the bank does not place a high priority on your mission, your business plan, your awards, or owning your capital. Now, those things are factors involved, but they're not the primary. Now, what I will say is, from working with the banks and then interviewing several banking officials, what I will say is, here is a list of the primary things that the bank actually cared about. And you may be surprised. Maybe you'll say, hey, that's a short list. But when we ask a lot of banks, and even through the process of working through it, this is what the bank cared the most about. These three things: your credit, your financials, and your cash flow. So let's start with the credit. The main thing that people need to understand when it comes down to your credit is that your credit score tells a lot about you. It tells a lot about a lot about your financial dealings. And so here's a probably a simple way for you to think about. Now, here's a simple way for you to think about, what does your credit score actually tell me? It tells me who trusted you in the past. It tells me who currently trusts you. And then it tells me, how did you treat their trust? So when you say who trusted you in the past, meaning like, who trusted you enough to give you their money in the past. And when on your credit report, there's going to be a history, and it's going to tell me who has given you money in the past. And then it's also going to tell me who is currently trusting you, like who currently trusts you with their money. And then the next thing is going to tell me is, how did you treat their trust? Like, what did you do when they trusted you with that several $1,000s they gave you? How did you treat that trust? Did you pay them back? Did you become delinquent? Did you get behind and then you did what you had to do to catch up? Now, what people don't realize is, a lot of times when the bank is looking at your credit score, they're really looking at it and they're analyzing it from these three areas. And you are not going to be there more than likely to actually explain your side of the story. So when you start thinking about your credit score and you start thinking about what goes into your credit, think about it this way. This is going to tell me who has trusted you in the past. If other people didn't trust you with their money, then this bank may not feel like, hey, I don't know if I want to be the first one to trust you. And then it also tell me like, okay, who's currently trusting you? Because you could have had trust in the past where people gave you loans. And if you didn't treat that trust well, maybe new people don't want to give you a loan because you're too risky. And then, like I said, it also tells me, how did you treat other people's money when they gave it to you? Did you do what you said you were going to do? Did you pay them back? Or did you, just use their money and, like I said, ruin their trust? The other thing on the financials is, Now, what really matters in the financials, what the bank is looking for is to see how organized are you? Do you have organization? Do you have process, procedures, and clarity around what are you doing with your money? Because there are so many businesses that have struggled and that weren't able to get access to funding that they needed to grow their business because they could not produce financial statements. I mean, during the first round of PPP and through even as I talk with the SBA on a regular basis, like I've been talking with the SBA and people that work in the SBA like on a monthly basis. And one of the things that they mention a lot is that a lot of people struggle to be able to qualify for the loans because they can't produce financial statements. And what the financials tell me is, do you have some type of organization to understand what are you doing with the money that you are getting? What did you do with the money you got from whether it's vendors or I mean whether it's from creditors, or what are you doing with the money that your customers are paying you? Like you should be able to tell the story of, hey, here's what our revenue is, here's what our expenses are, here's what our profit looks like. And then on the balance sheet, you should be able to actually say, hey, here's what we own, here's who we owe, and here's how much we owe them, and here's the equity piece. So when you think about, your income and your expenses, that's going to be your profit and loss statement, and it's really going to tell us, okay, all right, who's shopping with you, what are they buying from you? Like it'll tell you timing, because it's like, hey, are you making more money in the first quarter versus the last quarter? When you start looking at your finances, you start to understand more about, hey, how money is coming in, and how you are treating and how you are utilizing the money. And then on the ownership side, I mean, it's going to tell us what you own, which are your assets, who you owe and how much you owe them, in your liabilities. And then it tells us what you have, the equity, the piece of your assets that you actually own after all your liabilities are covered. Now, if you don't have financial statements, I strongly, strongly urge you to get with a bookkeeper or get with an accountant, and really get a good grasp on what your financials look like. Because if you don't have clear financials, then a bank may not take you as serious when it comes down to you trying to get a loan. And to be honest with you, if you're trying to bring on investors, there are some investors who won't even look at your business if you don't have actual financials or projected financials. So you want to make sure that you have some type of financials. The last thing is cash flow. Now, here's how cash flow works. Now, when you've been operating your business, one of the things you look at is cash flow is broken into several parts. It's the operating, which means this is the amount of the net cash activity from your operating, meaning when customers buy your product, they give you money, you take that money and you pay your operating expenses. Well, however much cash is left over, typically that's going to be what your operating cash flow is. Now, there are some other intricacies to that, but in general, for most businesses in the early stage, your operating cash flow is going to look very similar to your profit. Now, that may vary, like I said, if you have AR, AP, and inventory. But then in the financing section, this is money that you're either getting from other creditors or money that you're paying back to your creditors. So your loan proceeds versus your loan payments, different things like that. That's going to be in your financing section. And your investing section is money put in by the owners or by investors into the business. That's the general point of what's going to be there. Now, the main thing that banks are really looking at is they're trying to see, do you have more cash coming in your business than going out of your business? Once they see that, they're like, okay, all right, you have more cash coming in than going out. Great. Then they want to break it down to see, okay, all right, where is that cash coming from? Because there are some businesses where you have cash in the bank account, but it's only because you've been taking out more loans. It's not because your business is operating efficiently and your business is creating positive cash flow. It may mean is, hey, you went out and you took out more loans. That's the only reason why you have money in the bank. So the question that the bank is asking is, if I gave you money today, would you be able to pay me back? Because if I gave you money and you don't have enough cash flow to pay me back, eventually I'm gonna either have to write that off. I'm gonna have to actually, take ownership of your collateral, which is what I don't want. And the bank is gonna say, how risky is this situation to me as a bank? If you can't pay them back, then it really doesn't benefit the bank as much to give you a loan. Your risk may be way too high. So there you have it. The three things that banks really care about. And I'll go back to that. Is the simple three things that banks actually care about when it comes down to whether or not you are going to get a loan from them is the primary things are going to be your credit, your financials, and your cash flow. If you can tell a convincing story through these three core areas, I'm telling you, it becomes a lot easier for you to be able to get a loan from a bank if you can tell the story through these three areas. Now, I know a lot of people are probably wondering, like, well, I'm not an expert in these things. Like, that is why I advise you definitely work with, whether it's your financial advisor, whether it's a bookkeeper, whether it's a fractional CFO, whether it's a firm like mine that does bookkeeping and CFO services. Work with someone who can help you start to look at these core areas of your business, because as a business owner, you have to learn how to think about these things, especially if you are trying to get a loan. So, as always, thanks for watching and continue to look out as we release more great content like this.